Welcome again to our second session for financial accounting introduction. Thank you so much for those who subscribed, who viewed the first video. I hope you enjoyed, commented, you liked it. And now today, for this session, we'll be proceeding with the introduction part of it. So welcome. You can have a book, a pen, and a calculator. Welcome. So now we are going to look at accounting equation, and the basis of it is that the accounting equation is the foundation of double entry bookkeeping. Shows that a company's assets are financed by either owner's equity, which is capital, or liabilities. So what is an asset? As we looked earlier on, an asset is what a company owns. What is a liability? A liability is what a company owes others. And also you have capital, which is owner's investment in the business. So what is the formula? The formula is assets equals to owner's equity, which is capital, plus liabilities. In short, you can say A is equal to C plus L. A stands for asset, C stands for capital, and L stands for liabilities. And notice that this equation must always balance. So you have the definitions there. As you've said, an asset is what a company or a business owns. Liability is what a company or a business owes others. And owner's equity or capital is owner's investment in the business plus profits retained. So let us look at one example, which I've called it example 1. Suppose cash in the bank is 100,000 shillings, that is an asset. Loan from KCB Bank is equal to 60,000 shillings, that is a liability. And owner's equity, or what we are calling capital, is equal to 40,000 Kenya shillings, that is capital. So then, how are we going to use our accounting equation? Remember, asset is equal to capital plus liability. A is equal to C plus L. We have our asset, which is 100,000, is equals to our liability, our capital, which is 40,000, plus our liability, which is 60,000. And therefore 100,000 is equals to 100,000, and the equation is balanced. Example 2, a cyber cafe owner buys computers worth 300,000 shillings using 150,000 shillings from a loan from Equity Bank and 150,000 shillings from their own savings. So how do we use the accounting equation here? Remember, assets equals capital plus liabilities. That is, A equals C plus L. 300,000 equals to 150,000 plus 150,000 in this case. This means that 300,000 is equal to 300,000, and the equation is balanced. Example 3, a farmer buys a tractor worth 800,000 shillings, pays 300,000 shillings in cash, takes a loan of 500,000 shillings from Cooperative Bank. So how do we use the accounting equation? Remember, A, asset is equal to capital plus liability, that is A is equal to C plus L. Therefore, 800,000 is equal to 300,000 plus 500,000, which gives us 800,000 equals 800,000. And obviously, as we said, the equation must be balanced. A task for you, my viewer, you can try this one during your own free time, and even maybe post the answer in the comment section. A small business in Kisumu has the following cash at hand. We have cash at hand on 20,000 shillings, stock or inventory 80,000 shillings, loan from Family Bank 100,000 shillings. So you are asked to look for capital, and you are required to identify the assets, liabilities, and calculate the capital using the accounting equation. So that one you can try during your own free time and see whether you can work it out. Now, let us look at qualities of useful accounting information. One quality is relevance. Why do we say accounting information should be relevant? When do we say it is relevant? It is when it helps users make predictions or evaluate past decisions. Can this information be used to make predictions about the future or evaluate past decisions that were made by a business or a company? For example, let's say we have a Nairobi-based investor who uses Safaricom's quarterly financial statements to decide whether to buy more shares or not. Then we have timeliness. Information must be available quickly enough to influence decisions before it loses value. Let's say, for example, you have a supermarket in Kisii which prepares weekly sales reports to detect fast-moving goods and avoid stockouts. We also have the third quality is reliability. When do we say that accounting information is reliable? It is when it is accurate, verifiable, and free from bias. An example, let's say we have an NGO in Eldoret which ensures all donor funds are supported by receipts and bank statements for auditing purposes. We also have consistency. Accounting methods should be applied in the same way over time to ensure accurate trend analysis. For example, let's say you have a hotel in Mombasa which uses the same depreciation method for its furniture every year to track true asset value. Then finally, we have comparability, where financial information should be prepared in a way that allows comparison across time or between organizations. For example, so we have a student who is comparing KCB and Equity Bank's financial results over 5 years, and this student must see figures prepared using similar accounting standards. So those are some of the qualities of useful accounting information: relevance, timeliness, reliability, consistency, comparability. So those qualities ensure that there is useful accounting information. Thank you for watching the video, for listening, for being with me through the session. I hope you enjoyed. You can subscribe to my YouTube channel. You can like the video, comment, and even share. Till next time, bye bye.